The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you all for joining in for this session on futures and options strategy. Firstly, let me introduce myself. My name is Tarang Solani, and I am the product manager for derivatives, and I will be the host for this session. So, before starting, can anyone reply on the question answer section? Is my voice audible to you all properly, and is my screen visible? We'll request everyone to please reply on the question answer section. Is my voice audible to you all, and is my screen visible? Okay, can I get more replies, please? Okay, thank you very much. Okay, thank you. Thanks a lot. What we'll be covering in this session is firstly, we'll give you a basics of options. What exactly are options? What is call options? What is put options? And then we will also showcase you some of the important strategies which you can do in different market scenarios, because options is the only instrument wherein you can trade in all the market trend, being it bullish, bearish, range bound, or volatile. So with the help of this strategy, you can safeguard your loss, and also you can hedge your positions. So in case your view goes wrong, you don't lose much of it in the market. So let us begin. So first, what we will be covering is the basics of options, that is call option and put option, and then we will showcase you option trading strategies, each and every scenario like bullish, bearish, range bound, and volatile. And also, if you want to hedge your portfolio, or you have any kind of big positions in any of the particular stock, how you can hedge that. And then we will showcase you some of the very key important features of HDFC securities, F&O, and USP of it. Why into trade features and options with HDFC securities? What are the benefits of it? So without wasting any time, let us begin. So first, let us understand about options. So there are two types of options. One is call, and the second. So there are two types of options. One is call option, and the second one is put option. So if you're bullish, to explain you in a layman language, if you're bullish, you need to buy call option to take advantage of your bullish view. If you're bearish, you can buy put option to take advantage of your bearish view. However, you can take advantage of the bearish view by selling call option, and you can take advantage of bullish view by selling put option. So how? Let us understand in a further slides. So here is an option of I am a bullish on market. Current market is at 17,300. So in this scenario, what I will do is I will buy call option. So in this scenario, I have taken an example that I am buying 17,500 call option at 150 rupees. So this 17,500 is called as the strike price, and 150 rupees whatever I am buying is called as the premium. So I am buying 17,500 call option at 150 rupees. Now here the catch is, if you are a buyer of an option, your risk is just limited to the premium which you are paying it, and your reward is unlimited if in case your view goes right. So here in this scenario, if Nifty moves on or above 17,500 levels, you tend to make unlimited profit. However, if Nifty starts moving below 17,500 levels, you only lose 150 rupees per share and not more than that. So that is the beauty of buying of call option, wherein your risk is limited. That is the premium which you have paid, and that is only your maximum investment. So to enter this 17,500 call option, you need only 150 rupees into 50 shares is the lot size of Nifty. So around 7,500. You just need 7,500 to participate in the market of 17,500 by buying 17,500 call option, wherein your risk is just limited to the 150 rupees per share. But if your view goes right and Nifty starts moving above 17,500 levels, how much ever it goes above 17,500 levels, you tend to make unlimited profit. So here in this example, we have made you understand. So suppose if Nifty expires at 17,900 and you still hold on to your position, so you tend to make 250 rupees per share as a profit on an investment of 150 rupees. So around 1.5 times you can make on your investment. How 250? That is difference between 17,500 and 17,900 is 400 points, and you have already paid 150 rupees as a premium. So net net you will be getting it 250 rupees if Nifty expires at 17,900 level and you still hold on to your position. So this is the beauty of being a buyer of options, wherein your risk is just limited. You can participate in a very less investment and your reward is unlimited. Now take an example of selling of option. As I made you understand, if you have a bearish view, two ways where you can take advantage of a bearish view: by buying put option or selling call option. So here I have a view that Nifty at any cost won't go above 18,000 level. So what I will do is I will sell 18,000 call option at 100 rupees. I am getting a lot of queries that my voice is getting disconnected in between. So can anyone reply? Is my voice getting disconnected? Okay, so I think there might be the problem in the. So is it fine? Okay, so there is a mixed review. So I will try to be in a good connection. So here I was saying that Nifty, I've sold one lot of Nifty at 18,000 call option. So in this scenario, I have a view that Nifty won't go above 18,000 level. Hence, what I do is I am selling 18,000 strike price call option at 100 rupees. I am a seller of an option. The risk reward just gets reversed. If I am a seller, my risk is unlimited. If my view goes wrong and Nifty starts moving above 18,000 level, I tend to make unlimited loss. But if my view goes right, that is Nifty doesn't go above 18,000 level and it expires on or below 18,000 level, then I tend to make 100 rupees as a profit, and that is only my maximum profit. So here your risk reward functionality just gets reversed about what it was in the buying of an option. If you're a seller, your risk is unlimited, and your reward is just limited to the premium which you are receiving it. So here you are receiving 100 rupees as a premium by selling 18,000 call options. So if Nifty expires, if in this payoff table, if you will understand, if Nifty expires on or below 18,000 level, you tend to make 100 rupees per share as a profit. But if Nifty starts moving above 18,000 level, then your loss is unlimited. Suppose Nifty expires at 18,300, you tend to make 200 rupees per share as a loss. So how 200? Because difference between 18,000 and 18,300, that is 300 points. It went against 300 points, but you have already received 100 rupees as a premium while selling 18,000 call options. So net net you will be losing 200 rupees per share. So this is the functionality. However, since your risk is unlimited, selling of option required more amount of margin, because to compensate your risk, exchange will demand more margin. So in this case, the margin requirement would be approximately 80,000 rupees to sell these 18,000 call option at 100 rupees. So net net, your maximum profit in this is only 5,000. That is 100 rupees into 50 shares is 5,000, and not more than that. But your loss would be unlimited if in case it goes above 18,000 level. Now let us understand about put option. So what is put option? So buying a put option is like an insurance policy. So two way you can look at put option. First is if you are bearish, you can buy put option to take advantage of your bearish view. That means if a particular stock or index you have bought put option, if it goes down, you tend to make a profit because put option prices will increase. And same way you can use put option as a good insurance to your particular stock or portfolio. So how? Because insurance, I am sure you might have heard about, or you might have bought any kind of a vehicle insurance with you. So what happens in that, when once you bought any kind of a vehicle insurance, so vehicle you pay premium to buy that insurance. So here also, if you buy any put option, you pay premium to buy that put option. So in the case of insurance, that vehicle insurance company will assure you that if anything happens to your vehicle or if it gets stolen, it will get compensated. But here in put option also, suppose you buy 17,000 put option, but this 17,000 put option will compensate that if Nifty goes on or below 17,000 level, will compensate to you. So here is an example that I'm buying Nifty 17,000 put option at 80 rupees. So here in this case, I am a buyer of an option. So in this case, if Nifty closes on or below, yeah, in this case, my since I'm buying 17,000 put option at 80 rupees, so here my investment is only 80 rupees into 50 shares. That is 4,000 rupees is my investment. And if Nifty closes on or above 17,000 level, my loss is just 4,000 rupees and not more than that. But if Nifty starts moving below 17,000 level, which was my view that Nifty will go on the lower side, and I tend to make unlimited profit. So suppose if Nifty closes at 16,500 level, I tend to make profit of 420 rupees per share on an investment of 80. That is around 4 times I can make on my investment. So how 420? So difference between 16,500 and 17,000 is 500 points, and I've already paid 80 rupees to enter this position. So net 420 I will be making if Nifty expires at 16,500. I still hold on to my position. So this is the beauty of buying of options, where your investment is very less and the risk is also limited to the premium which you have paid, that is your investment, and your reward is unlimited if in case your view goes right. Now, as the example of selling a put option, that in which scenario you will sell put option. If you have a view, if you have a bullish view, in this case, either you can buy call option or you can sell put option, depending upon your risk-taking ability and also depending upon the confidence you have on your view. So here I have a view that Nifty at no cost will go below 16,800 level. You might have seen there is a very good support at 16,800 level, and I have a view that Nifty won't go below 16,800 levels, but I don't know that Nifty from current level will go up or down. But one thing I'm sure that it won't go below 16,800 level. So that means I'm bullish above 16,800 level. So what I will do is I will sell 16,800 put option at 50 rupees. So here, since I'm a seller of an option, your risk is unlimited. If in case Nifty starts moving below 16,800 level, your risk is unlimited. However, your reward is just limited to 50 rupees per share. If Nifty expires on or above 16,800 level, I will tend to make 50 rupees per share as a maximum profit and not more than that. So that was all about options. Now let us understand about different option trading strategies. As the topic in stage for the webinar is option trading strategies, a smart way to participate in market swings. So we will touch upon various market views, and based upon that, which kind of an option trading strategies you can do to cover all this market view, and how you can minimize your loss is the main motto for doing this option trading strategies. So let us understand with the first scenario. Suppose you have a bullish view on the market. So first strategy which you can do in a bullish view is to buy bull call spread. Now, what is bull call spread and when to initiate? When you expect an up move in the market and want to reduce the cost, at that point of time, you can initiate this bull call spread strategy. So rather than going long call, you can do this kind of a strategy wherein you can reduce your risk by where the cost is also reduced. So how to use this bull call spread is to buy one at the money call option and simultaneously sell one out of the money call option of the same expiry. So here, while selling the call option, you will receive premium. So whatever you have bought the call option by paying premium to buy the call option, you can compensate by selling call option so that your cost reduces and your risk is also reduced. So time frame is 7 to 14 days, and the exit rules for the strategy is once the event is over and once we reach a predefined level. So here is an example. Now in a bull call spread, around Nifty, suppose it's trading at 17,500 and I have a positive view on the market, but I am not so much sure on the positive view. So what I will do is, in this scenario, I will buy one 17,500 call option at 200 rupees, and to offset my risk because I am at full risk of 200 rupees if in case Nifty doesn't go into my direction. So to offset it, what I'm doing, I'm selling higher strike price call option of 18,000 at 120. So I'm reducing my cost because I will receive premium of 120 rupees. If I sell this 18,000, now net my cost is just 80 rupees, and that is only my maximum loss if in case Nifty doesn't go up and it expires below 17,500 level. However, I have reduced my cost. My profit is also now capped 18 above 18,000 levels. I won't get an unlimited profit. My profit will be capped above 18,000 levels. So here my break-even point for the strategy, that means at the level where I will start making profit, will be 17,580. How 17,580? Because I bought 17,500 call option and the net my cost is 80 rupees. So now my break-even point would be 17,580. So now maximum profit for this strategy would be 420 rupees. How 420? Because 18,000 above 18,000 you won't make any kind of an incremental profit. Your profit will be capped. So and 18,000 minus the break-even point is 17,580. So 420 rupees is the maximum profit you will be earning in this strategy. And that point of level that Nifty closes on or above 18,000 level. And maximum loss for the strategy is 80 rupees. That is your initial cost, and that is only a maximum loss. So with this payoff diagram, you'll be able to understand how this bull call spread is helpful. What you have done is you have sold the call higher strike price call option along with the long call option to reduce your cost, and also your profit have also been kept. If in case with 18,000 above 18,000 level, you won't make any kind of an incremental profit. So here in this payoff diagram, you will be able to understand that if Nifty closes on or below 17,500 level, you tend to make only 80 rupees per share as a loss. However, if Nifty starts moving up above 17,580, which is your break-even point, if Nifty starts moving above that level, your profit will increase. And at 18,000 level, your maximum profit of 420 rupees will be achieved, and your maximum profit will be 420 and not more than that. So here with low risk, you can participate in this in the markets in the market with the low risk, and you can participate on the bullish view. If in case the view doesn't work, you don't lose much. Against if you are naked on a long call, you might lose 200 rupees full if you don't square off your position and Nifty moves again. So net you will make less loss if in case your view doesn't go in your direction. However, you will make profit also, but that will be capped because you have sold call option at above 18,000 level. You won't make any incremental profit. So that was about a bullish view. Same way you can do a strategy with a put. That is, if you have a bearish view, the strategy name is bear put spread. It's same thing which you have understand about bullish. Here, if you have when to initiate bear put spread strategy, when you expect a down move in the market and want to reduce the cost, and same thing if you expect up move in the market, want to reduce the cost, you can do bull call spread strategy. But if you expect a down move in the market and want to reduce the cost, you have to do bear put spread strategy. Here, how to use this: buy one at the money put option, and simultaneously to offset your risk, you can sell out of the money put option of the same expiry time frame. If you're doing, you should hold. If you're doing for a monthly expiry, you should at least hold 7 to 14 days to be in a proper profitable position. And your exit rules would be: if your event is over, if you're playing this strategy for any event, if the event is over, you can exit this strategy. And if you reach any predefined level, that is the level which you have sold the put option, that is a predefined level. If you reach that level, then you should exit the strategy. And if you still have that view, you can initiate again strategy of bear put spread with a different strike price. So here I have taken an example. Suppose Nifty is at 17,500 level, and I have a view that Nifty will go down, but I am not sure about it. I don't want to risk full of my put option buying. I want to hedge my position also. I want to lower my risk. So what I will do is I will buy 17,500 put option at 180 rupees and simultaneously sell 17,000 put option at 80 rupees. So net my cost now reduces to 100 rupees. So if in case Nifty doesn't move into my direction, now I won't lose more than 100 rupees per share. But if Nifty starts moving in my direction, my profit will also be capped, and above, sorry, below 17,000 level, I won't make incremental profit. So here, if you see, the break even point will be 17,400. How? 17,500 put option you have bought, and total cost involved by doing this strategy is 100 rupees. So below 17,400, 17,500 minus 100 is 17,400, and below 17,400 you will start making profit, and your maximum profit would be 400 rupees per share, because below 17,000 level you won't be making any incremental profit because you have sold 17,000 put option, and your maximum loss for the strategy is just 100 rupees. So here in the payoff diagram, you will be able to understand that if Nifty starts moving down below 17,500 level, you will make profit. At 17,000 level, you will make maximum profit of 400 rupees per share. And below it, the profit will be continued 400 rupees per share. However, if Nifty starts moving against you, that it starts moving up, you won't lose more than 100 rupees per share. Now, due to this strategy which you have initiated, you have not lost 100 rupees. But if you have only gone long on put option, you might have lost 180 rupees full if you hold on to this position until expiry and Nifty doesn't go below 17,500 level. You might have lost 180 rupees full. But here you have offset your risk by selling put option at 80 rupees. So now your cost have also reduced, and you will lose only 100 rupees if in case your view doesn't go right. So now we will move upon different strategies called as long straddle strategy. So when to initiate this strategy? If you have a volatile view on the market, you can initiate this strategy. Now there are four types of view which could have happened in the market. Either you have a bullish or bearish, or also if you have a view that market will show a big movement in either direction, but you are not sure on which direction market would show a big movement, that is called as a volatile view. So in this strategy, what you will do, one strategy which we are covering is long straddle. Now, what is long straddle? So long straddle is a delta neutral or market neutral strategy. That means whose profitability does not depend on the market direction. So as I made you understand that you don't need to basically time where the market will head towards, but your timing should be, or you should have a view that market will show a big movement whenever this happen is when market is at a crucial resistance or a crucial support zone, or if there is any kind of an event in the market, then at that point of time there we do see a very big movement into the market, and that point of time this long straddle strategy becomes very much profitable. So long straddle is perhaps the simplest market neutral strategy to implement. So once implemented, the PNL is not affected by the direction in which the market moves. The market can move in any direction, but it should show big move in that direction. As long as the market moves irrespective of its direction, a positive PNL is generated. So here, when to create this strategy can be created on intraday and positional basis in weekly and monthly options. Ideal strategy, if one expects spike in implied volatility. Implied volatility is nothing but that gives us the idea based upon how the options are valued. Are they expensive or they are cheap? So if implied volatility, you have a view that the implied volatility will increase, that means the option price, despite market being at the same level, the option price will show a significant jump. So that means the option price have been becoming expensive. So if you expect that the market there would be a spike in implied volatility, which usually happens before any event in the near future, then this strategy is very useful. Can be created during any important event when IVs are very low and big movement is expected. Very effective in Nifty and Bank Nifty on day of weekly or monthly expiry, where usually big movement is seen in both the indices. So on the expiry day, you must have seen that the premiums are very low, especially in the last 1 hour or 2 hour of trade. The premiums are very low, and you can initiate this strategy. We do see a very volatile movement in last 1 hour or 2 hour of trade on the expiry day. So the strategy could be very much useful. So on the exit rules is a keep a stop loss of 10 to 20% of the total premium outflow, and you should book profit if the total premium which you have paid increases by 20 to 30 percentage. That should be your target. So you should play the strategy with a stop loss and target. And also you should exit if implied volatility falls. Then despite index showing sharp movement, the premiums won't go up that much. Hence, it is better to exit the strategy. So here we have taken what you will do in long straddle. You buy one at the money call option and same strike price, you buy one at the money put option of the same strike and same expiry. That is called as long straddle. So let us understand with the example. Suppose Nifty is at 17,500, so you buy 17,500 call and 17,500 put. That is called as long straddle. You buy same strike price call option and put option of the same expiry. So here you have bought call option at 120 and you have bought put option at 150. So net 270 rupees you have paid by buying 17,500 call option and put option. So now your first aim should be that Nifty should show movement uh, from current level should be more than 270 rupees either on the upside and the downside to be profitable. So your lower break-even point would be 17,500 minus 270, that is 17,230, and higher break-even point is 17,500 plus 270, 17,770. So here to be profitable, either Nifty has to go above upper break-even point or below lower break-even point. Then only the strategy would be profitable. So maximum loss for the strategy is 270 rupees. If Nifty expires at 17,500, then what will happen? The call and put option both will become zero, and you will lose full 270 rupees as a loss. As I made you understand, you need to play the strategy with a target and stop loss. Profit is unlimited. If Nifty expires below 17,230 or above 17,770, your profit will be unlimited. So let us understand with the payoff graph. Now here in this payoff graph, if Nifty expires between 17,200 and 17,800, you won't make much of a either you will lose this in the strategy. But if Nifty starts below moving below 17,200 level, your profit is unlimited. How much ever it goes below 17,200 levels, and same way if Nifty starts moving above 17,800 level, then your profit is unlimited. So you need to time that the market should show movement which should be more than your combined premium which you have paid, that is 270 rupees in this case, and then only you will start making profit. Now there is one more view in the market, that if you expect that the market would show a range bound view, that is it won't show a big movement in either direction. So in this scenario, what you can do is you can do short straddle strategy, which is an opposite of long straddle. This strategy is an opposite of long straddle, can be created when there is a range bound movement expected in stock or index. Very effective in low volatile stocks like Coal India, ITC. They are the low volatile stocks. You can create this kind of a strategy in that. How to use this strategy is sell one at the money call option and same strike price sell one at the money put option of the same expiry. Your exit rules here also, you should play with the stop loss and the target. Your stop loss should be 20 to 25% of the total premium outflow, because here you are selling the options, you will receive a premium. So if the premium decreases, you will make profit, and if premium increases, you will make loss. So you will make a stop loss should be 20 to 25%, and you should book profit if the premium decreases by 40 to 45%. So here the strategy can be created by selling at the money call and at the money put of the same strike price and same expiry. Let us understand with the example. So here Bank Nifty is at 14,000 level, and you buy Bank Nifty 40,000 call. Sorry, you sell Bank Nifty 40,000 call and 40,000 put. You feel that the Bank Nifty would consolidate at current level. So what you do, you sell 40,000 call and 40,000 put. You sell 40,000 call at 500 rupees and sell 40,000 put at 400 rupees. So net you will receive 900 rupees as a premium. Now in this case, since it's the opposite of long straddle, short straddle like strategy, you want that Bank Nifty should hover between this 900 points from the strike price which you have sold. So either Bank Nifty below, that is 40,000 minus 900, that is 39,100, and 40,000 plus 900 is 40,900. So you want that Bank Nifty should be in the range of 39,100 to 40,900 to make this strategy profitable. However, since you are a seller, your risk is unlimited. If in case Bank Nifty starts moving below 39,100 and above 40,900, your risk is unlimited. And if maximum profit with the strategy, if Bank Nifty expires dot at 40,000 level, you will incur maximum profit in this strategy. That is full 900 rupees you can pocket as a premium if the Bank Nifty expires dot at 40,000 levels. So here you can see in the payoff chart, since this is a range bound strategy, you want the options to be in a range, sorry, market to be in a range. So if Bank Nifty expires dot at 40,000 level, you will make full 900 rupees as a profit. However, if Bank Nifty expires between this lower break-even point and upper break-even point, then you would make some kind of a profit in this strategy. But if it starts moving below and above the break-even points, then your loss is unlimited because you are a seller of an option. So this strategy is quite risky. So you need to first time the market very well, and also you can play the strategy with a target and stop loss to reduce your risk. Now, one in the last strategy is an hedging strategy that is called as a protective put strategy. This strategy is very much useful for anyone who are having big holdings in suppose in E margin or MTF. If you are having a big holding, you can safeguard some of your loss by buying put option. So that is called as a protective put strategy. You can do it with your portfolio also. If you have a negative view on the market, if you feel the short term market will not perform, you can buy put option so that whatever loss you incur in the portfolio, you can offset that loss by, if the market goes down, you can offset the loss with the profit you will make in put option if the market goes down. That is called as an hedging strategy, which is called as a protective put strategy. Now, when to initiate this protective put or put hedge is a hedging strategy where the holder of a securities buys a put to safeguard against a drop in the stock price of that security. Now, when to create a protective put strategy is usually employed when the trader is bullish on a stock but wary of uncertainties in the near term. It is used as a means of protection. So, how you can do it? Let us understand. Now, suppose you have a bullish view on ICICI Bank. And now you buy one future of ICICI Bank at 830 rupees. Suppose it is quoting at 830 rupees. And you also vary of uncertainty. Suppose if ICICI Bank goes down, you can incur a big loss. So to protect that, what you do, you buy one 830 put option at 15 rupees. Now that is called as in hedging strategy, where protective put strategy, where you can, by just paying 15 rupees, you are protecting yourself on the lower side, because if you are just buying a one future of ICICI Bank at 830, your loss is unlimited if in case how much ever ICICI Bank goes down. But you are protecting yourself by just paying 15 rupees. That is called as an hedging cost. And if in case ICICI Bank goes down, you won't incur loss more than 15 rupees. However, you have paid in 15 rupees as a cost. Your break even will also be increased. That is from 830 to 845. 830 plus 15, that is 845 would be your break even point, and only above that you will make profit, and that is unlimited. So maximum loss for this strategy is 15 rupees per share if ICICI Bank expires below 830. So this strategy will be quite useful in a volatile market. You can hold on to your positions despite market showing whipsaws movement, because your protection is in place, and your profit would also be unlimited if ICICI Bank expires above 845. How much ever it goes above 845 level, your profit is unlimited. So it's a very good strategy. The same strategy you can incur call as protective call strategy. If you have short positions in any future, you can safeguard your short positions by buying call option to hedge that. So that is called as a protective call strategy. So here with the protective put strategy which we discussed on ICICI Bank, as I made you understand, if ICICI Bank goes on or below 830, you would make loss only 15 rupees per share. That will give you a cushion to hold on to your positions with a lower level. However, if it starts moving up, it needs to go above 845 level to be in profitable position. If it goes to 890, you will make profit of 45 rupees per share. Why 45? Because your break even is 845, and 890 minus 845 becomes 45 rupees per share you will make if in case ICICI Bank goes to 890 level. So that is the beauty of protective put strategy. Now let us understand our, as I made you understand, why you need to trade with HDFC Securities and what are his offerings. So first offerings is rupees 20 per order as a flat brokerage we have been giving to the HDFC Securities client. If you are not having this brokerage, you can avail to our derivative value plan, which is worth of 199 plus tax, which is an annual charges. So here you won't get rupees 20 per, you not only get rupees 20 per order as a brokerage, but also you will get a free access to Pro Terminal, which is our advanced trading portal. That is very much useful if you are an F&O trader. You need some kind of an analytical tool to zero down your positions of what to buy, what to sell. So this Pro Terminal will help you and guide you for that. So and if you don't have rupees 20 per order as a brokerage, you can avail to our derivative value plan. You can just Google derivative value plan in HDFC Securities. You can pay 199 plus tax, which is an annual charges. You can get rupees 20 per order, and same you can get an free access to Pro Terminal. But before that, if you need to make sure that you have a derivative privilege with you. Only if you have a derivative privilege, that is a privilege to trade in futures and options, then only you need to opt for derivative value plan, or else the benefit of derivative value plan would not be applicable to you if you don't have derivative privilege. If you opt derivative privilege after subscribing derivative value plan, then this would not be applicable to you. So make sure you have derivative privilege first, and then only you subscribe for derivative value plan. And one more advantage of trading in derivatives with HDFC Securities is zero interest on derivatives margin. What exactly it refers is, suppose you are short of cash while trading in derivatives, and you want to take any positions, but you are short of cash. So what you can do, you can pledge some of your portfolio, some of your shares of your portfolio, and against that, whatever margin you receive, you can avail that margin to trade in derivatives market without any interest cost. So our competitor do charge an interest of 18%. Suppose you use 1 lakh of margin to trade in derivatives market with a competitor, they charge 18% on that. That is an interest. If you hold this position for 1 month, you pay interest of 1500 rupees. But with HDFC Securities, you can use your portfolio as a productive means where you can earn returns from it, and we don't charge any interest if you use that collateral margin to trade in derivatives market. There is no interest involved in it, and there is 0% interest in it, and you can use it for unlimited time. So it's a very good option and very good feature, basically, which can use your portfolio as a productive means to trade in futures and options market. So if you're short of cash, you can use this kind of a facility without any interest cost. So here you don't have to avail anything. It is automatically, this facility is given to all our clients. You just have to follow the rules of by pledge your shares, and in 1 day you will receive some pledging link from NSDL. You need to confirm this pledging with NSDL, and you will be on the next day you will be given the limit to trade in derivatives market, the collateral limit after haircut, and you can trade and take any kind of positions without any interest cost. So that's it from our end. Now we'll open this forum for question answer section. If anyone has any kind of questions, we'll request you to please write it on the question answer section, and we'll reply you back. So we have already got some feedbacks that the voice was not properly audible. So I apologize for that, because there has been some disturbance. So I apologize for that, and we'll make sure that next time it won't happen. So we'll request everyone to please write any kind of questions. If you have any kind of doubt, you please write it on the question answer section. We'll reply you back. And if in case you missed out this, you're not able to hear this, you can refer to our YouTube channel of HDFC Securities, wherein we have uploaded these videos of future and option strategy. You can refer to that, and also you can use it so that you can get more clarity. A question I got, in bull or bear spread, we are buying and selling different strike price. Don't we need to square off at both the prices? Yeah, we need to square off at both the prices. So if you are buying both different options, so we have to square off that options also now. So Venkata is asking, will you be talking about futures trading? No, this is specifically for options strategies. So I have been focusing on that too. We on Monday we'll have one more session where in basic we will make you understand about futures and options. So you can basically attend that if you want to understand about futures. Thiru is asking a very good question. Can full margin come from pledge or need some percentage of cash? So yes, full margin can be availed with a cash margin. Full margin can be availed in the for collateral margin. You can use it in derivatives market. You don't have to basically contribute any kind of an cash margin if you want to initiate any position. You can avail full collateral margin to use that. 100 percentage has been allowed. So Mitra Investment is asking, would like to have clarity on futures hedging. So what kind of an clarity you want to have? Basically, if you just can elaborate. So Mr. VS is asking whom to contact for recording of this session. So you can refer to our YouTube channel of HDFC Securities. Uh, you can refer to our HDFC Securities YouTube channel. So one important question has been asked by Mr. Karan. In hedging part, if we have two quantity of future, then to hedge, do we need to take two quantity of put? Yes, perfectly. So if you are hedging two quantities of future, for that you need to have two quantities. That will be a perfect hedge. So Mr. Thiru is asking about brokerage. I think 20 is for sell and buy or per leg. So if 17,000 put option buy and sell on expiry, it is 20 or 40 rupees. So it will be if you do it on the intraday. Suppose you buy 17,000 put option first. You will pay 20 rupees as a brokerage, and again you square off your positions of 17,000 put option. Again 20 rupees of brokerage would be charged. So it will be charged on both the legs. It won't be charged on only single leg, Mr. Thiru. Mr. Kumar is asking, I'm new in HDFC Securities. Do you give classes for options trading? So yeah, we do have this kind of an webinars. So on Monday, we'll having a basics on futures and options. You can attend that webinar on Monday of basics of futures and options. So wherein you can understand and make your concepts clear. So we don't provide any kind of a candle. We just stick to our derivatives. It is candlesticks and all those things are the technical parameters. So right now we don't have any kind of an webinars which we conduct for technical studies. We only have a webinar to educate on derivatives, how to trade in futures and options, what is futures and options, how you can trade with HDFC securities, which are the order benefit or order types, and which are the various strategy where smartly you can trade in options. So we only cover that. Candlestick patterns and all those are technical parameters. As of now, we don't cover that. One more question by Mr. Samir: is there criteria or minimal requirement to enable derivative privilege? I found the page to apply to enable, but could not find criteria. So, Mr. Samir, there are different. I will just give you the link. I will just share the link first. So here you will be able to see to opt for derivative privilege, you need to basically upload any one of the documents. I will just showcase you the one second. So I'll just provided you the link. This link, once you basically, I have provided to all. So once you register, once you click on this link, you will be asked to upload any of the documents. So I'll just share my screen. You can upload any of the documents from the given picture. So here my screen will be visible to you. So you can take a snapshot of this. So out of this, any documents with all the requirements, you will be able to see. You can upload any of the documents as mentioned with the conditions also mentioned in the right hand side, and the list of the documents are also mentioned. So any one document is required, and make sure you adhere to the conditions which are mentioned. You can take a snapshot of it so that it becomes easier to upload any kind of a document based upon these conditions. And to register, I have given you the link. You can register it online by uploading any of the documents. Mr. Rajiv is asking, Pro Terminal is also available in mobile. Yes, it is available. You can go to a Play Store and type Pro Terminal. You will be able to get, and you can use the same credentials. Um, Mr. Mitra is asking how to use futures and options combined for hedging. So as I made you understand in my presentation here only, so I will again make you understand regarding ICICI Bank. So here, suppose you have a bullish view on ICICI Bank and you buy one future of ICICI Bank at 830 rupees. Simultaneously, you want to safeguard your option, safeguard your position if in case futures go down. What you do, you buy ICICI Bank put option one lot at 830 rupees. So what you have to do is you have to make sure you are selecting the strike price which is near to the initiation position which you have taken at, so that your cost has been reduced. So here you are selecting the strike price at 830 is the strike price I am selecting because I have bought the position of ICICI Bank future at 830 rupees, and I paid 15 rupees as a premium, which is called as the hedging cost. By buying put option, you need to pay some premium. So here in this case, I'm paying 15 rupees as a premium by buying 830 put option. So here what I will have now, if you do this strategy, you are protected below 830 rupees, and below 830 rupees, how much ever it goes, this is the hedging cost of 15 rupees. That is only your maximum loss if in case ICICI Bank starts moving below 830 rupees. But your profit will start above 845 because you have incurred 15 rupees as a hedging cost. So you need to add this hedging cost with your buying future, that is 830 plus 15. So about 845, you will start making profit, which is unlimited, and maximum loss is 15 rupees per share. So here, if you check this payoff chart, your ICICI Bank, how much ever it goes below 840 or sorry 830, you will make loss of only 15 rupees per share if you initiate this strategy with future, and also you buy put option to hedge. And if it goes, how much ever it goes above 845, it starts moving above 845, which is your break even point, your profit is unlimited. So this is how you can use futures and options to protect your future strategy, futures position. One more question by Mr. Jaspreet Singh is, if we buy quantity of future, at which time we have to purchase put option for protection? It should be at the same time, because if you don't incur at the same time, there might be chance that you are buying at a quite lower rate put option that will incur more loss. So it is always recommended if you buy it at same time. Mitra Investment is asking, why don't you offer trading in options for more than 3 months? So are you talking about long dated options? So we have open long dated options, but as of now you can only buy long dated options. You cannot short sell long dated options. So you can buy long dated options till December 2023 expiry, but you cannot short sell as of now due to liquidity parameters. We are in touch with the concerned team to also provide this kind of a facility very soon. But yeah, long dated options has been open for all of our clients, wherein you can only buy right now, but you cannot short sell it. So I think we have covered most of the questions. There are no more questions. So I thank you all for attending this webinar. I hope this was quite useful, and I apologize for the background sound and which you have already given an feedback for that. So I'll make sure that it doesn't happen again. So I apologize for that, and I thank you all. Hope this session is quite useful and you understand. As I made you, as I also told you that if in case if you want to see any kind of an recordings for this session, you can refer to our YouTube channel under HDFC Securities. This is where we have already uploaded some videos about futures and option strategy. You can refer that. So thank you all, and have a wonderful day. Thank you.